As the markets turned volatile, investors were reminded of the old lessons around greed and fear in various ways. Look at what happened to highly anticipated IPOs like a Paytm and even a Zomato. Clearly, there's lots to learn from these two stocks while making an informed decision about applying to the much-awaited LIC IPO. Here's a checklist to keep in mind. Number 1. Valuations and fundamentals. Investors keep making the same mistakes again and again, and it was no different during the recent IPO wave. Chasing hot themes does not always work. In 2021, tech-driven companies were all the rage, but not all of them made money. Paytm stock, if you look at it, has lost two-thirds of its value from the IPO price of 2,150 to trade at 600 rupee levels. Others such as Cartrade Tech and PB Fintech, which saw a bumper listing, are also now quoting below the IPO price. Stock prices tend to track the fundamentals of the underlying business of a company. If the company is not making money or is in a very competitive industry, then in turbulent times, shares of such companies go down and they may take time to bounce back till the fundamentals improve. Valuations are also important, and in the case of new age companies, they were very expensive. Also, many investors did not have clarity on how to value these new age IPOs, and that too is a concern which has been reiterated by experts. Do you really understand the business? Many successful investors, including Warren Buffett, talk about investing in a circle of competence, the subject area that matches a person's skill or expertise. It says an investor is better placed to make investment decisions if he or she understands the underlying business. However, investors often confuse this with familiarity. Being a customer, you can have an opinion about the quality of the goods and services, but that does not mean a customer understands the business model, margins, profitability, future growth, and even valuations. Ignoring your investment goal and exit strategy is one of the biggest mistakes you can make. You have to make a choice between listing gains and investment. Experts suggest when you're applying purely for listing gains for an IPO, an upward trending market definitely helps. When the market is fueled by liquidity and trading in an overbought territory, selling on listing definitely makes sense, and even if the gains are small and at times even with small losses. When the markets are going up, one has to be cautious to avoid landing into traps during good times. Next is keeping a stop loss. There are situations where despite all the efforts, one may go wrong. In that case, a stop loss strategy can come to your rescue. Define how much money you can afford to lose in each IPO. If the stock goes below that level, just sell and exit. Now, this will help you avoid deeper losses. And if the price of a stock does go up after hitting the stop loss, one can always re-enter at a later stage once there's more clarity about the future. And finally, there's the angle of tax planning. Smart investors tend to book their capital losses to reduce their tax liability. So if you have some dud stocks received as IPO allotment, this can be a good time to take a relook. Consult your advisor. If you sell below the IPO price, you're booking your loss, which can be offset against some of the other profits and bring down the tax liability as well. As the market returns to normalcy, you may get many more opportunities to invest. So if you free up your capital by selling these dud stocks, then you are better placed to pick fundamentally strong companies going forward.